In the last couple of days, we actually had quite good macro data when it comes to the CPI report or PPI report. They actually came in better than expected. Now, of course, lagging indicators, right? Maybe a month from now, the numbers might not be as good as what we've got in the last couple of days. But the trend is literally going into one direction. And if the Fed does not want to cut rates anytime soon, then I guess they are targeting deflation. Remember the comments from Jerome Powell not so long ago, right? Talking about, oh, I understand that people are not happy with the fact that prices are still going up. Well, his own target of 2% inflation also means that prices will continue to go up. It's just that inflation growth is coming down, right? The rate of inflation is slowing down, which is exactly what's been happening. Now, if you want prices to stop going up and to come down, that's deflation, not inflation. So the target is a bit strange here. So we're going to talk a little bit about some macro data. And then I want to touch on my new number one position in the portfolio, which of course is now, well, Amazon. There was a letter from Andy Jassy, and I do think that he mentioned quite a lot of important stuff in that letter. So let's talk about all of that. If you enjoy this type of videos, hit all the buttons, would really appreciate that. And if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. All right, so first up, a little overview of the heat map of what's going on right now at the time of making this video, which is right at the open. Well, a bit better than on Thursday, but still a lot of red across the board. Moving on to some macro data. So here we can see this is the 7th straight week with over 50% bears, matching the record in October 1990, which was the bottom of that bear market. Looking at what the options traders have been doing in the last couple of weeks and months, well, previously they were extremely bullish and now they're very, very much bearish. It's, well, as bad as we were back in the COVID crash and back here in the great financial crisis. Switching to the tariff war, China raises tariffs on US to 125% and says it won't go higher. Given that there is no longer any possibility of market acceptance for US goods exported to China under the current tariff levels, if the US side subsequently continues to impose tariffs on Chinese goods exported to the US, the Chinese side will pay no attention to it. Okay, so now we went from 84% to 125%. Moving on to some inflation data. So we've had the CPI report a couple of days ago, and by the way, this is basically the difference between CPI and PPI. Now, PPI report 2.7% year over year. The estimated number was 3.3%, so we're better there. The month over month one was actually a decrease of 0.4% versus the estimated number of 0.2%. If you look at PPI core, same thing here, came in better than expected. Now, if we look at these are the month over month ones, we can see that we are actually trending and doing quite well at the moment. Looking at the United States core inflation rate, well, the trend here is quite clear, right? Since the peak at the end of 2022, the trend has been, well, that we are going lower and lower, and actually going back to levels not there yet, but we're going back to levels not seen since before the pandemic, which again, in my opinion, will lead to the Fed to cut rates more than expected this year. And yes, despite everything that's going on with tariffs. If we look at the current correction, bear market, whatever you want to call it, equities had one of the sharpest drawdowns in the past 100 years. Average S&P 500 performance around bear markets and correction. This is the data since 1929 with 16 bear markets and 29 corrections included. By the way, just so you get the full picture. Since 1929, we only had 16 bear markets and 29 corrections. So not bad, right? Not bad. And this is basically us right now, that orange line right here. So yeah, for all of you that still think that, oh, we can go much lower. Yes, we can go lower, but let's not be that greedy. Moving on to some comments from Jamie Dimon. JP Morgan and a lot of other banks have reported their quarterly figures before the market opens. So he said the following: this economy is facing considerable turbulence, including geopolitics, with the potential positive of tax reform and deregulation and the potential negatives of tariffs and trade wars, ongoing sticky inflation, high fiscal deficits, and still rather high asset prices and volatility. As always, we hope for the best but prepare the firm for a wide range of scenarios. Now, and this is, by the way, the same thing that investors should do. You should hope for the best, prepare for the worst. This is what you should do with your portfolio, whether it's to maybe buy treasuries or maybe just increase your cash pile, or maybe you can short the market while also being long stocks. So that's your hedge basically. You can do that. You can do that. And I mean, the quarter for them was I think a double beat, and I think they even raised their net interest income for the year. So far, so good for them. Moving on to the Amazon part of the video. So Andy Jassy has released a letter to shareholder for 2024. It's pretty long, so I'm not going to go all over it. But basically the main point here is the, well, wild culture at Amazon, right? Questioning the status quo, talking about how Amazon started by, well, why can't we sell a lot of books or every other book that's out there to customers? Why not? And then why just books? Why not some other products and services? Why does it have to take so long to get a product to a customer? Why can't we do this faster than before? So it's always about the whys, etc., etc. It even gives us a couple of examples here. Why not allow our sellers to also store items in our fulfillment network? Enable those items to have fast prime delivery and fulfill those items for sellers. A program called FBA, or Fulfillment by Amazon. Then, talking about AWS here. Why does every company need their own capital-intensive data centers and infrastructure? Why should every development team keep reinvesting services like compute, storage, database, and analytics? Why should builders spend 80% of their time on the undifferentiated heavy lifting versus the unique customer experience? Why not build a set of services, AWS, to solve that for internal and external builders? Remember, when AWS was launched and they were burning a lot of money, all of Wall Street was questioning Jeff Bezos whether this was actually a good thing to do. Well, it was a very, very good thing to do. He continues, why do I have to buy a physical video to watch a movie? Why do I need cable or linear TV to watch amazing TV shows? Here comes Prime Video. Why can't I get my Prime shipping benefits on other websites than just Amazon? And this is where Buy with Prime came into play. And he continues to talk about the why culture, questioning the status quo, etc., etc. And then he gives us actually a lot more examples. And then, yes, of course, they are going to talk here about AI. Now, before talking about that AI part of things, right, they are questioning every single thing. Why this, why that, why this services and not that service, right? Amazon is one of those companies where you can literally see that this is a company that kept on expanding and expanding its total addressable market, right? Starting from online stores. And now look at what we have. Now we have online stores, physical stores, third-party seller services, advertising services, subscription services, AWS. You have Amazon Medical One or healthcare side of things. That's also going to be bigger and bigger. They're also going to be very, very big when it comes to, well, their project Kuipers, which is basically a competitor to Starlink. Of course, yet to be, well, as competitive as previously expected, but it's Amazon. So I do believe that in the future, there's going to be quite a big return on investment, quite a big, what they say, ROIC, return on invested capital. And so Amazon, to me, right now, it's the largest position in my portfolio, surpassing Tesla. And I'm very comfortable with that. I've always said it time and time again. I think Amazon, if I had to have a portfolio where I basically buy a couple of stocks and then I cannot change anything to that portfolio for many, many years, Amazon is probably going to be the number one stock that I will pick up. Moving back to the questions about AI. So why is AI so important? Will it really have as much impact as some claim, and when? So Gen AI is predicted to fundamentally transform almost all customer experiences and enable entirely new ones. Early applications focus on productivity and cost reduction. AI will increasingly impact areas like coding, search, shopping, personal assistance, healthcare, research, and more, which of course, all of those categories here, well, Amazon is in those categories and might even expand itself if they are buying TikTok. I don't know if that's going to happen or not, but it's a possibility. Companies that don't leverage AI will become uncompetitive due to its AI ability to process vast data, learn continuously, and develop agentic capabilities. More on that in just a second. The significant impact won't be immediate within a year or two, but will materialize faster than previous technological shifts within the next decade. Next question. Okay, I buy AI is big, but why invest this much this quickly? Well, Amazon's mission to improve customer lives daily necessitates deep and broad investment in AI, as they believe it will reinvent every customer experience. Over 1,000 Gen AI applications are being developed across Amazon to enhance various customer-facing areas. AWS is rapidly building foundational AI technologies, including their custom silicon, Trainium, flexible model services such as SageMaker and Bedrock, proprietary models such as Nova, and agent capabilities. Significant upfront capital investment in AWS infrastructure, data center, and chips is required to meet growing AI demand, even though monetization occurs over the long term. It's always a long-term story and strategy at Amazon. The current period of high AI demand justifies aggressive investment, which is expected to benefit customers, shareholders, and the business long term. Then, why do chips and AI have to be this expensive for customers? And it's of course an indirect dig to NVIDIA, right? Why do these GPUs cost so much? Current AI costs are high primarily due to reliance on single expensive chip provider. Amazon's training chip aimed to offer significantly better price performance. While training costs are substantial, inference model predictions will dominate future AI expenses due to its constant and large-scale nature. Making inference cheaper is priority for Amazon. Improvements in chip price performance, model efficiency, and infrastructure will drive down AI costs over the next few years, and lower AI costs will lead to broader adoption, more innovation, better customer experiences, and ultimately increased overall AI spending, similar to the impact of cost reductions at AWS, which is exactly what we've all been talking about since that DeepSeek moment. And then the last part here is coming back to personal assistants. Why have personal assistants not yet taken off? How can Alexa help? Previous digital assistants lack the ability to both answer questions and perform real-world actions effectively. Alexa Plus is positioned as a game changer, combining chatbot-like intelligence with the ability to execute a wide range of actions, playing media, controlling smart homes, ordering, making reservations, etc. With over 600 million existing Alexa devices, Alexa Plus is expected to become a much more crucial tool for these users in the future. I don't really think that they're going to stop there. I think Amazon is already one of the biggest robotics players, and I think we're going to see probably a sort of humanoid robot, or at least a robot in your house that comes from Amazon. I mean, remember, they wanted to acquire iRobot, and I think that was not really a big surprise. And so all in all, that's about it. I think in the meantime, the markets will still be a roller coaster. But me personally, I truly think that on Monday, the market might have a bottom. That doesn't mean that we're only going to have green days. No, remember yesterday's video, which was filmed before the market opened, well, way before, I showed you the data where basically we had a day where 97% of the stocks in the S&P were green. What happened afterwards? And the odds were not that great. Which is why we saw a huge reversal on Thursday. It's not just because of that, but it's also because we're still in that uncertainty period. Plus, plenty of people just forgot that tariffs are still in place. It's just that it is 10% right now across the board. Plus, well, China is now at 145%. So we're still in that waiting period. But I do believe that with every big announcement, with every deal, with every partnership, the markets will come down a little bit. And of course, we are now entering the next earnings season. So volatility is to be expected. On the Amazon side of things, it's one of the easiest holds in my portfolio. Truly one of those no-brainer positions. What do you think? Let me know down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.